Welcome to Iron Financial. This is the place where we help you forge a stronger portfolio by cutting right through all the market's weakness. Today, we are putting Academy Sports and Outdoors, that's ticker ASO, under the microscope. Now, on the surface, their latest quarterly report, it looks like a solid beat. You might even call it a clean victory. But here at Iron Financial, we don't just admire the paint job. No. We stress test the foundation. We're here to find out if this company is truly built to last or if it's just a pretty facade.
That's exactly right. The market sees a headline beat, the stock pops a few percent, and everyone moves on. But our job is to ask the really tough questions. Is this a genuine fortress of value, a company that can actually withstand the economic storms they're brewing? Or is it a house of cards, something that's just propped up by really low expectations and is ready to completely collapse at the first real sign of pressure? That right there, that's the core conflict we're digging into today. Is the hype real, or is it just masking some very serious, very deep structural problems?
Okay, let's get into it. To get to the absolute truth, we've structured this entire analysis like a blueprint. First, we're going to look at the headline beat. Those are the top-line numbers that got everybody so excited. Then, our resident skeptic here is going to go searching for the cracks in the foundation, the numbers that tell a very, very different story. After that, we're going to examine how management says they're forging a new path to reinforce the business. Then we'll weigh the macro headwinds that could frankly blow the whole thing down. And finally, you know it, we'll deliver the Iron Financial verdict. Right. Let's start with the bull case. Section 1, the headline beat. Look, if you were just glancing at the trading terminals when these numbers dropped, you saw what looked like a really strong performance. The company successfully cleared the bar that Wall Street had set for them, and let's be honest, in this market, any kind of beat is seen as a major sign of strength. It gets people's attention. Okay, so let's drill into the key number that really got the market's attention, $1.96. That was their adjusted earnings per share for the fourth quarter. Now, the Street's consensus forecast, it was sitting way down at 182. So what you're looking at is a nearly 8% beat on the bottom line. That is a significant number. It signals, at least at first glance, some really strong operational control and profitability. I mean, this is exactly the kind of result that gets the trading algorithms to start buying and gets the short sellers to start covering their positions. It's a powerful signal. And it wasn't just on the earnings. The top line, the revenue, that also came in a little bit hot. They posted $1.68 billion against an expectation of $1.67 billion. Now, okay, that's a much narrower beat, right? They're just edging it out. But a beat is a beat. And when you can deliver on both the top and the bottom lines, you create this really powerful headline narrative. The story becomes that this is a company that is executing well, a company that really has a handle on its business. And that is the story the bulls are telling right now. Okay, hold on. Whoa, that's the glossy brochure. That's the sales pitch you get from investor relations. But we're here to do the heavy lifting, right? So let's move to section 2, cracks in the foundation. Beating expectations is one thing, I'll give you that. But what was the quality of that beat? What happens when you actually look beyond the headline and you start to pressure test the underlying structure? Because that's where a much more concerning picture really begins to emerge. And this slide right here, this illustrates the central problem perfectly. On the left, you've got that headline beat we just talked about. Looks great. But look over on the right. That's the reality check. Net sales didn't grow. They actually declined by 6.6% compared to the same quarter last year. So the crucial point, and you really need to let this sink in, this is not a growth story. The business itself is getting smaller. They only beat expectations because the analysts had already priced in a pretty significant decline. They just declined a little less than everybody feared. That's not a fortress. That's just managing a retreat. And listen, this is not a one-time problem. This is not a blip. Just look at this chart of comparable store sales. That's the metric that measures sales at stores that have been open for at least a year. It is a sea of red. Quarter after quarter after quarter of negative comps. Analysts were already expecting a decline somewhere between negative 0.3% and negative 1.0% in Q4. And guess what? The company delivered right within that shrinking reality. This trend shows a persistent, fundamental problem with getting their existing customers to spend more money. The traffic at their stores has been deteriorating. This is a foundational crack that you simply cannot ignore. But you know what? The biggest warning signal of all doesn't even come from their past performance. It comes from their own forecast for the future. When a company's leadership team tells you what they expect for the next year, you need to listen very, very carefully. And Academy's guidance for the upcoming fiscal year, well, it was a significant miss. It's like a giant red flag waving directly from the C-suite, telling all of us that they see some serious turbulence ahead. Let's put some hard numbers to that so it's crystal clear. The Street, Wall Street, was expecting adjusted earnings per share of $6.37. But look at management's guidance. The high end of their own range doesn't even get to that number. They're basically telling us, point blank, we expect to underperform what you guys are hoping for. This suggests that the internal team, the people with the most information, they are far more cautious about the year ahead than the market was. They are telegraphing weakness, plain and simple. And finally, let's pop the hood and look at the balance sheet. This comes straight from their 10-K filing. This is the financial bedrock of the entire company. On the left, we've got February of last year. On the right, this year. Take a look at the cash position. It's down from roughly $348 million to $289 million. Now look at the inventories. They're up. They're up from about $1.2 billion to over $1.3 billion. So let me spell it out. Less cash on hand and more money tied up in unsold products sitting on shelves. This is a classic, textbook sign of retail stress. It massively raises the risk of future markdowns just to clear all that inventory out, which would absolutely crush their profit margins. This is a clear weakening of the core structure. Okay, you've pointed out the stress fractures, and they are absolutely real. No one is denying that this business has been under pressure. But that's only half the story. Management isn't just sitting on its hands watching these cracks spread. So let's get to Section 3, forging a new path. They are actively reinforcing their growth plan. They're bringing in new materials, new strategies, not just to patch the holes, but to build a stronger, more resilient structure for the future. So the crucial takeaway here is that management isn't just playing defense. They have a clear 3-pillar plan to rebuild that forward momentum. Pillar 1, they are not retreating. They are aggressively expanding their physical footprint with new stores. Pillar 2, they're not just selling the same old gear, they are elevating their entire brand with premium partnerships. And Pillar 3, they're not just sitting back and waiting for customers to show up, they're actively going out and acquiring new ones. This is an offensive strategy. And that second pillar, the partnerships, it's not just some vague promise. It's a game-changing move that's happening right now. They are launching the Jordan brand in 145 of their stores this April. Folks, this is a massive catalyst. Jordan isn't just another product line. It is a cultural phenomenon. It drives significant foot traffic into stores, and maybe even more importantly, it's an accretive brand from a margin perspective. That means it's a high-quality, high-profit addition that has the potential to lift the profitability of the entire apparel category for the company. And this right here, this quote, brilliantly illustrates their pivot in customer acquisition and how successful it's been. The CEO, Steve Lawrence, he said it himself on the earnings call, "We're the value provider in our space." And what's happening is they're leaning hard into this identity, and it's working. The company reported that they are seeing continued growth from upper-income customers. Think about that. These are wealthier shoppers who are trading down to find better value in a really uncertain economy. So this isn't just about holding on to their core customer anymore. It's about actively capturing a new, more affluent demographic that discovered them during the pandemic and is now sticking around. That is a strong counterargument, I'll admit. The internal plan sounds robust. But, even the best-built house can be seriously damaged by a hurricane. And that brings us to Section 4, the macro headwinds. Look, management can execute their plan absolutely perfectly, but they cannot control the weather. And right now, there is a major external storm brewing that could undermine all of their hard work. You simply cannot analyze this company in a vacuum. You have to look at the environment. So let's break down this storm. First, you've got tariffs. This is a constant threat that could dramatically increase their sourcing costs, which would either force them to raise prices on their customers or just absorb a massive hit to their profit margins. Second, their core consumer is under immense pressure. The company itself states that 60% of their customers have household incomes below $100,000. That is the exact demographic that's being hit the hardest by inflation in this economic uncertainty. Third, the sporting goods space is fiercely competitive, and it's saturated. There's a lot of competition. And finally, there's just broad economic uncertainty. In a downturn, big-ticket discretionary items like grills and kayaks and hunting gear, those are the first things people stop buying. These are powerful external forces that are completely out of management's control. All right, we've laid it all out. We've seen the bull case, a company that's beating expectations and executing a very clear turnaround plan. And we've seen the bear case, a shrinking business with a weakening balance sheet that's facing a very harsh economic environment. So it's time to bring it all together for Section 5, the iron financial verdict. Is ASO an opportunity to buy into a comeback story at a good price, or is it a classic value trap just waiting to spring on unwary investors? This slide here is our final weigh-in. We're putting it all on the scale. The bull case, that foundation they're trying to build on, it rests on that strong Q4 beat, their aggressive new store growth plan, the massive Jordan brand catalyst, and their proven ability to attract those wealthier shoppers. But the bear case, all those cracks in that foundation, they are simply impossible to ignore. The persistent negative comps, the year-over-year sales decline, management's own weak guidance for the year ahead, and of course, the significant macroeconomic risks we just outlined. It's a true tug-of-war between their internal initiatives and these powerful external pressures. So, here it is, the iron financial verdict. Academy Sports is not the stable, finished fortress that the Bulls might want you to see, but it's also not the completely collapsing house of cards that the Bears might be claiming. The best way we can describe it is this. It's a structure that's under heavy renovation, but it's happening in the middle of a potential storm. They are doing the right things internally. The Jordan deal is a big win. The store expansion makes sense, but they are doing it with a weakened balance sheet and at a time when the economic environment is becoming increasingly hostile. This creates an enormous amount of execution risk.
And that really leads to our final and most crucial question. And this question isn't for us, it's for you. This is not a simple buy or sell recommendation. It is a high-risk, high-potential renovation project. The upside could be significant if their plan works and the economy somehow holds up, but that downside is just as real if those macro headwinds prove to be too strong and that storm really hits. So you have to look at your own portfolio and ask yourself, is it properly fortified? Is it diversified enough to take on this kind of construction risk? That right there is the heavy lifting you need to do. Thanks for joining us on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.